Hello. How are you doing? How are things? Hopefully okay. So what's going on today in State of the Market? All right. I got some stuff. Don't want that one. We are going to talk today. As soon as I can find what I wrote up. There we go. What are we talking about today? So first off, Powell speaks today. I don't know if you're going to get a lot of actual trading done today. As far as things moving around, I think it's going to be pretty quiet. Trump announced the tariff against India. Nothing really happened. So I think the tariff ship is starting to sail. We now are trying to get something out of the Powell ship. But today, what I want to talk about is what is trading from a theoretical value, and what it is. If you don't know what that is, you came to the right place. What is rules-based trading? I'm going to give you an example. And here's my mantra. When it is fair, I do not care. So by the end, you'll understand what that means. When it is fair, I do not care. I want the market to give me a goodie before I put the trade on. And the longer you hang around Option Pit, the more you'll learn what those goodies are. And then last here, what is triple confirmation? The concept of looking at values before you get into a trade instead of just having a vibe or a feeling. So we're going to talk about those today. And hopefully it will help your trading. So the first thing is, right, because the market ain't doing anything, is SPY up. What is it? SPY up 2 ticks. Let me see here. I don't think it's anywhere. Nothing. Everything's just going to sit here and wait for the Fed. It's ridiculous. Anyway, that's my soapbox, but I won't get on it. The first thing about trading from a theoretical value is what? What's a theoretical value? Okay, that's given a set of inputs. And then you pump them into the model. Okay, you get some outputs. You get a value. Okay, global warming. Okay, everybody freaking out about global warming. Well, it's just a theoretical value. They put in a bunch of Earth data, and they have models, and it spits out a result. The difference is, it depends what kind of data you put in there. Options, right? These are our inputs. So we have volatility. We have interest rates. We have dividends. What else do we have? Time to expiration. And we have something else, strike. And underlying price. And that basically gives us our model. That gives us our model. A lot of what we teach at Option Pit is when you're trading this, and this helps define the position you want to trade. What I'm going to call rules-based trading, right? Input expectations, define the trade type. Once you start trading like that, and not just saying, I'm just going to put calendars on everything because it always works. No, it doesn't. Right? I'm just going to sell the credit spreads all the time. Doesn't work all the time. Right? Because these inputs are going to move. And once you learn that you can game volatility, you can game your time to expiration, right? That's basically the theta part, the decay part. And understanding how underlying price moves. It's not, yeah, you can predict it going up and down. I think the only people that are really good at that in here are Alicia and Hans. I'm a better volatility mover than an underlying price mover, but I just let the underlying price move to where I want to go. But the idea of this is you have these inputs and it's going to generate a number, what your option is worth. So the theoretical value is just, what is my option worth? Option worth based on some set of inputs. Now, the thing is, once you start trading like this, or start thinking about it, like all the products at Option Pit have this form of structure. The only thing that's different is we're trading different inputs. Some products like Rip Zone, weekly profit cycles, more volatility, a little underlying price, right? Option Shopper, her challenge, small account challenge, right? Time to expiration important, wanting action early. Hans, he wants longer term action, right? I think only an exception here would be like Big Money Flow with Mark, looking at things that would sort of, that's more like game theory. But every product here, trading product, is based around an input moving that we can follow, right? So a rules-based trading strategy, you have to develop some input expectation to define the trade type and the rules. So if I want to buy options or buy strangles or buy anything, what makes me buy them? Right? So if I buy options, what makes me buy options? Now, in my world, the way I think about a trade, an option trade, in order to trade options, you need an edge and an opinion. If you just have an opinion, just go vibe the stock. Why bother with the options? You only want to trade the options when you feel like you have some kind of an edge. Okay? An edge is defined at something more or less than theoretical value. So if you're an option buyer, you want to buy options, you want to buy them for less than the theoretical value, what you perceive as the theoretical value, or what your rules tell you is the theoretical value. If you're a seller of options, you want to sell them for more than what your rules tell you is the theoretical value. You can have any rule set you want. I'm not here to tell you your rules, right? I've had students for, oh my gosh, 30 years. So I'm not here to tell you whose rules are better than others. If they work for you, they work. If they make money, they work. That's all. Doesn't matter. It doesn't matter anything else. If you make money with your rules, they work. It's all that matters. So for me, what makes me buy options, so now I have to I got to write a list. If I buy options, first off, okay, I want lower implied volatility, which basically just means I want cheap option prices. Okay. Why do I want cheap option prices? Why does anybody want cheap option prices? And cheap has many meanings. But basically, the less the option costs, the easier it is for it to grow up and become a big option, which you can sell. So, right, I want lower implied volatility. In general, I want higher realized volatility. Right, so if I'm going to compare, right, this is basically, is the stock moving? Okay. Okay. I want lower implied volatility. I want higher realized vol. I'll put all the, I'll answer. You guys put your questions in there. Put your questions in there. And I'll address them at the end. What else do I want? What would you want if you're buying options? Okay. I want momentum. Right? Right? I want momentum. I want everybody to already like it. So I see a lot of questions coming in, which is great, and I'll hit all the questions at the end. I want momentum in a direction. Okay. You know what else I want when I buy options? Is I want a good profit target based on the expected move. Okay. Which generally means I like around 100% gain as the expected move. Because it's like, I don't want to buy options without at least 100% possibility. Do I hit it all the time? No. Sometimes I hit it after I close them, whatever. But I want, based on expected move, I want 100%. Right? Now, all of a sudden, I have some rules. Here's a question. Does anybody have these kind of rules before they go buy an option? Your rules can be better than mine. Throw your rules in. Because there's a lot of options out there to buy, right? If you think about it, how do you know what to buy? You could buy any, like, you know, there's how many thousands and hundreds of thousands of strikes. So the idea is, I want to establish an edge. All right. And then from there, I can decide if the trade is worthwhile. So here, right? And then after you get to that point, then you decide if the trade is worthwhile. Right? Because it still has to be able to make you enough money for the expected move. So these are what I would call at least 3 things that I'm looking for. So again, I like the idea of triple confirmation. What's that? That means these are things. These are market indicators that I need to see happen. I want the market to come to me, meaning I want option prices to be relatively low. The stock is moving. It has momentum, which already means there's dollars pushing in. And I want a good profit target based on, if I buy this option, do I have a good shot of it paying me basically double what I paid? Now, the problem is, how the heck do I answer all those freaking questions? So again, when I was a floor trader, I did everything in the opposite direction. I let everybody else decide what they want to do. And then I just took the other side and managed the positions. But now as like a retail trader, that's all I am now. I got to wait till something. So now I have to change how I look at the market. So when I look at, if you pull up an option screen, okay. So here's a live vol screen. Again, if I would recommend, if you are serious about trading options and you probably have a $100,000 account, you're at a disadvantage not having a live vol. It's just too much information. This was developed in a pit when I was a floor trader in 2004. I watched this product being built because there was nothing really like it at the time, as everything was going off floor. So this is basically how a floor trader would look at the market. But when you look at this right now, is this telling you any information about what to buy? If you look at this screen right here, here it is. I'm still claiming this is the best product out there in the world to help you trade. But if you just look at the basic option montage, although when I look at it, I see different things, but it's not really telling you as a retail trader what to do. It's just a bunch of prices and blips. So the idea of trading from a theoretical gives you a starting point. Does everybody get that? You want a starting point. Okay. And this is what I mean when it is fair, I do not care. Meaning, if I'm paying something for an option that is just what the expected move is, where there's no edge versus how I think the stock is going to move, then there's no reason, because then I have to fight decay to win. So I want to look for options relatively cheap or relatively expensive. And there are many, many ways to do that. Many ways. So what I have here is basically 4 things. Now, it just so happens at Option Pit, we sell tools to basically what I would call high-end, sophisticated retail traders that are live vol subscribers. Now, on Thursday, we're going to do something different. Something totally different. But it's the same idea. Meaning you don't have all this data. You're going to have very narrow data for something. Right. And I think it's going to change retail trading. So I'm pretty excited. Anyway, that's a sideline. But we already do this kind of thing at Option Pit already. Okay? Already. Teaching our more advanced students how to trade from a number. So I got a lot of questions. And now I'm going to start to give you some answers. So in front of me here, all you're seeing is a lot of numbers, a lot of colors, a lot of blinky lights. What I see here when I look at this is it's telling me immediately whether I should buy options in IBM or not. And I know from looking at this sheet, it's giving me a trade already. Will it make money? I don't know. I don't know. If I knew if every trade was going to make money, life would be pretty easy. Although I do know it's giving me an edge to start. Which I like. So, a couple of things. Cheap implied vol. anytime I see these little blue blinky lights here, I know the implied volatility is relatively low to how the stock has been just moving. Anytime I see these little blue blinky lights. So that's step one. I also have two different ways to look at realized vol. How much it's trading close to close, meaning yesterday's close to whatever today's close is going to be. And that gives me a value, what's called realized volatility, for different trading periods. I got 13 days, 8 days. Basically, I'm just here using what the most recent strikes that are going to expire. So if I'm interested in the August 15s, right, that's 13 trading days of activity for me. The realized vol just recently for IBM is 36%. It's a little over 2% a day. They're going to charge me a 22 volatility, which is about 1%, 1.5% per day for the options to carry until August 15th. So this is now information I know. Again, if this is over your head, that's totally fine. Because, hey, we have classes to teach you here. Show up tomorrow on Thursday and learn something. Here, all this does is tell me if I buy something, if I buy a straddle, and we traded a 36 volatility for 2 days, I know that straddle that I paid $9 for is going to be $11.37. If we just spend 2 days in one direction. If we go 4 days in one direction, my $9 straddle will be worth $13.21. If we go down for 4 days in a row, right? Because when you have a realized vol, that's okay. I'm going to move $1.25, and in our case here with IBM, that's more like $5 a day. So if I move $5 a day at a 36 vol, I'm all of a sudden 20 points away from where I started. Same on the upside. Now the ATR, that is the range per day. So it's a very low of the day and the very high of the day. So if I feel like I want to day trade the options or have like 1-2 day trades, I'm more interested in the ATR. Basically, how much is it moving intraday? Right now, IBM, again, we just had earnings, had a big drop. And that's trading around a 53 volatility with the huge gap. And actually, this was a trade we looked at in Rip Zone a couple days ago, made a little money. But again, this is the process to go through, that I go through looking for a trade. So when I look at IBM and I put in a symbol up here, I want to know right away, is it worth it for me to buy options? Okay, I see the stock's moving, might have a little momentum. How much are they charging me? So what I have is this idea of like triple confirmation. I got multiple ways to see if this trade is a good starting point. And then you put your trade on and you let it run. And then your job as a trader is to what? If you're going to trade options, what's your job? What's the hardest job trading options? To manage and close the trade. Right? That's the part where you fight psychology, you fight your little gremlins, you fight your little greedy monster, all these things. Closing is the hardest. In Option Pit, CTS. Was it Chip coming up with that, Shane? Or you came up with that? Close that stuff. I'm just going to tell you, closing is the hardest part. But it's easier if you know, like, hey, I know in 2 days, I've actually got an expected value of a trade at $12.16. Now, would you pay $6.50, almost $7 for a trade you think is worth $12 in 2 days? Would you do that trade? Yeah. So now it's worth looking at. Now, I think the realized vol on IBM is coming down a little bit, but the Fed's going to talk. You know, we got August 1st trade deal stuff. So we could have a little bit of movement here. Again, this will be a topic we hit in Rip Zone again today. But what I'm trying to give you is, do you see how trading, if you have an idea of what things can be worth, what they're worth now, and what they could be worth in the future based on what's going on, how that could change the way you trade options, change the way you trade overall. You could do this with anything. Iron condors. What's the chance of my iron condor paying me? Right? What's the chance of my credit spread paying me? What's the best credit spread? Right? What makes a good calendar trade? What makes a good strangle? What makes a good straddle? What makes a good call purchase? Right? These are all things, right? Now we have probably a dozen sheets that look like this, looking for different things in the market. Right? So triple confirmation is, I have factors that I want to see. And you need all those things. All right, so I only have a couple minutes left. Again, if you want to see this, WA is asking, what do you use? What do you choose the best AI to best undervalue trades? Show up tomorrow. Listen to Mark. He'll have some answers for you. He's been working on this for like 6 months. All right, some other answers here. Some other questions. How do we determine the expected move? Asks Andrew. So I think the easiest way, look at the straddle value for the term. That's the easiest way to look at expected move. Momentum, I do use simple momentum indicators. Is it up? Is a stock up for 3 days? Is it up for 5 days? Right? An old floor trading rule was 3-day rule, meaning basically, I don't care until the stock's up at least for 3 days in a row, and it either fails at that point or keeps going. Okay? That's a simple momentum rule. Leisha is very good at using charts. I am not. I just look at the tape because that's all I did when I was a trader. How do I determine realized vol? I calculate it right here. If you have Thinkorswim, you have they'll call it on Thinkorswim historical volatility. How do you put the volatility probability on your side? You always, so the easiest way to put volatility probability on your side is you want to be buying where the volatility is going to, or you want to be selling toward against where the vol is. Basically, depending on where realized vol is. It's the easiest way. As far as, how do you have volatility probability? Basically, the simple rule is like, a body in motion stays in motion. The Newtonian volatility trading. So, right? Show up Thursday for, if you want to see a rules-based triple confirmation approach to trading options. Mark and Hannah will, again, I think people had to sign an NDA to check it out because it's the first time this has ever been launched. It's kind of cool. It's going to freak people out a little bit. You want to check it out. WA says, I can't wait till Thursday. Well, you got to wait till Thursday. And IBM options are darn cheap. AG, what happens if Powell surprises? Oh, I don't know. I think we're like 650, 655 SPY, Surf Dancing Hogan. But I don't think he will. He hasn't yet. All right, everybody, have a good day. Sign up, 7 p.m. Thursday. Reese, there's always the replay for you. All right, everybody, have a good day. Bye-bye.